Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. This segment's brought to you by CommercialAgentSuccess.com. Check it out. It is the ultimate in training for commercial agents. Learn more at CommercialAgentSuccess.com. Well, here we are at the end of 2022. And the question, I think, on everyone's mind is what is going to happen in 2023 for transaction volume, for performance, for the economy, for inflation, for, just what's going to happen moving forward. Well, please welcome my guest. It's Tim Bodner, and Tim is U.S. Real Estate Deals Leader with PwC. Tim, good to see you again, sir.
Good to see you as well, Michael. Thanks for having us.
Great. And you guys do a report, a Real Estate Deals Outlook every year. You just came out with your 2023 Real Estate Deals Outlook. And I'd like to ask you about that. What are your expectations moving forward? And I think one of the things I like to start with is really transaction activity. And, when we look back at 2021, I know there's a lot of comparisons for transaction activity in 2022, third and fourth quarter, to 2021. And, I'm a broker. We were doing deals all over the Southeast. And in 2021, it was just crazy. It was, you had the scare, right, of the 1031 exchange getting limited to $1 million. You had the capital gains increase scare, and it created a lot of activity. And, of course, interest rates that historically way low. So when we compare to 2022 third and fourth quarter volume to 2021, is that really fair? Should we go back a little further?
Yeah, it's a really important point, Michael, in terms of how we look at things. And when you look at it relative to 2021, it is down over 20%, kind of quarter over quarter. But if you do the analysis that you're referring to and you compare it to kind of quarters to 2020, 2019, and prior to that, it is one of the most active years so far that we've seen. And so our view is that transaction activity is down. We can talk about the reasons as to why, but we still believe that 2023 will be a year of transaction resiliency that we'll see in particular in a subset of sectors.
Okay, well, that's good to hear that you expect 2023 to have good transaction activity. Let's say someone's listening or watching and says, all right, Tim Bodner, what do you mean? Their interest rates are high. People are still concerned about pricing discovery. Why are we going to see good deal activity?
Yeah, so clearly, the market environment at the present time is choppy. There still are a lot of headwinds on that everyone is facing. Interest rates, inflation. We still have a war happening in Europe and other geopolitical matters, and so it is a very challenging macro setup. Having said all that, when you look at the fundamental trends that are driving activity in certain sectors like logistics, the residential related themes. And then what we've been talking about for a while is what is starting to become, to us, an era of kind of the experiential related sectors. Those secular trends are present and they haven't subsided. And so we think those tailwinds are going to be the drivers behind activity in 2023. And, we think that will accelerate meaningfully once we have some of these headwinds be tempered a bit, particularly as the Fed here in the U.S. Starts to kind of slow down the pace of interest rates and people have more clarity into where some of those things are going. Right.
And you mentioned that you expect more transaction, I guess, in certain sectors and property types. What do you see there?
Yeah, so look, right now in residential related themes, if you look at manufactured housing, there's several, above $3 billion transactions in the market that are in various stages of processes. There's a tremendous amount of capital that's been oriented towards single family residential. By some market statistics, there's roughly 80 to $90 billion of capital pointed at single family residential. There's a number of joint ventures that are pointed at affordable affordable housing and solving some of the structural issues that we have with housing. So there's a lot of pipeline in and around residential related themes. Similarly, if you look at the experiential related sectors, we continue to see activities happening in the hotel management sector. We've seen activist campaigns being pointed at certain experiential corporate owners of real estate. And we've seen an insatiable demand for mixed use developments in and around sports related themes. If you look at the major leagues in the U.S., in the professional sports area, I think that the last kind of numbers that we've accumulated here, it's something like $21 to $22 billion of activity that's slated for 2023, 24, and after. So that's what we're seeing in the pipeline, and why we think that in those areas we're going to see resiliency in 23.
That's interesting to hear. And what is your outlook then for REITs moving forward into 2023?
Yeah, look, November was a great month for REITs because the disconnect between private and public markets closed a bit, but we've seen a little bit of that trade off. I think the reality is what the REIT sector is going to experience is a significant focus on strategy, on operations, and driving shareholder value. And some of that we've seen already. Activist campaigns be squarely focused on that. That's what they're focused on in that area. I think some of the numbers that we looked at is that the real estate related activist campaigns, if you look at the third quarter of 22 versus the third quarter of 21, they're up 43% year over year. Activist campaigns pointed at real estate. And it's not necessarily in all cases focused on transaction activity, but it is focused on strategy and operations. And so that's going to be what we're going to see the REITs having to focus on. I think if they're unable, and in some cases, some of the activists have been quite clear and direct in their messages that if you're unable to act on those strategy and operational related factors, then we think you ought to transact. So the REIT market that's going to be their area of focus for the balance of this year, which only have obviously a couple weeks, and then for sure in 2023 and after.
We're talking with Tim Bodner with PwC about their 2023 Deals Outlook. And, Tim, the multifamily market's certainly been robust and been a tremendous amount of activity. But we also had huge rent increases, right, overall year after year. Well, now we're starting to see that slow down and in some cases almost level off or drop here recently. You said you expect decent and good transaction activity in 2023. What about for multifamily?
Yeah, look, I think when you look at residential related themes generally, the clear focus is on affordable housing. And so certainly while the pace of the fundamentals that we've seen in multifamily generally over the last number of years in terms of rent growth on new and renewal leases has been slowing, we think that a lot of the transaction activity that we'll see in the residential themes will move more towards an affordability. And we've seen that in a number of different cases already in terms of new partnerships and alliances between various institutional investors and operators.
Do you think there'll be much distress? I think a lot of investors like to buy when the market's a little slower. Maybe they get some better prices or looking for opportunistic opportunities. Do you expect much distress in 2023?
Certainly there is if you look at certain parts of multifamily, if you look at office, if you look at retail, the trend that we've talked about in other publications, including our emerging trends in real estate, is that there's definitely a flight to quality. And as that flight to quality continues to occur, there are assets that are going to be become distressed and will have to be worked out in various ways. There's certainly a lot of market participants that are starting to act on that in terms of increasing their staffing levels to address an increase in distressed activity. So we do think that there will be distress in the system, but in those particular areas, and we don't see it being something comparable to kind of what we saw, for example, back in the financial crisis.
Yeah, yeah, it makes sense. And one of the opportunities with in these cycles, a lot of investors really prefer a cycle, I guess, that we're going into now with higher interest rates, maybe less buyer competition. Maybe if you look at commercial real estate as a long-term hold, maybe you're getting in at a better price per square foot, a better basis to start with. So do you expect cap rates to continue to increase? Do you expect cap rates to maybe have leveled off? Any expectations there?
Yeah, listen, over the last couple of weeks, I've had the privilege of being all over the world, in Asia and in Europe this week, and in the U.S. And I think regardless of where you are in the world, there's a prevailing expectation that cap rates are widening somewhere in the range of kind of 75 to 100 basis points. So certainly there will be cap rate adjustments that will flow through. I think the important thing that you touched on in your question is that the level of activity from investors who have a long-term time horizon and are able to kind of look through the choppiness associated with the current macro setup, the fact that we will have, it feels like some kind of a recessionary period, they are still incredibly active. And so, investors like that will kind of in the short term help, create market activity where where other investors have kind of pulled back a bit.
Yeah. Yeah, it seems pretty amazing. Some of the properties that we're selling some office buildings, some portfolios. And when I look at the prices per square foot that you can acquire a property for now and compare it to replacement costs, it's like, wow, on a long-term hold, that's got to be a win, right?
Yeah, I mean, look, the dynamic that's created because of the inflationary impact on replacement costs, like you're saying, and if you have that, compare that dynamic to what's happening with cap rates, that actually creates quite an attractive setup for opportunistic investors. And there's a lot of capital on the sidelines in opportunistic related themes. The challenge that is out there right now is the depth and liquidity in certain segments of the financing markets, and so we need the financing markets to kind of open up further, which we think will likely happen kind of towards the second half of 2023, which will enable that opportunistic capital to be deployed at scale and address the dynamic that you were just alluding to, Michael.
Yeah, good point. And I'd like to see the lenders get a more active than they are. There's certainly lenders that are active, but some have really slowed down and are being cautious. Where do you think there might be some opportunities in the market in 2023?
We believe increasingly we have more and more conviction around real estate opportunities that are in and around experiences, and there's a number of ways to express that thematically through kind of from an investment perspective. And what we're seeing a lot of our clients spending time on is exactly how to deploy capital into that theme at scale. Certainly, if you look at activity in certain segments of the hospitality area around all-inclusive resorts and the like, there's continued to be examples of that. But there's some bigger opportunities, particularly around, if you look at what's happening in sports, as I mentioned, if you look at live experiences, particularly in certain markets like Las Vegas, there's a tremendous amount of demand for capital. And that's where we see a lot of opportunity, and where a number of our clients are spending significant amount of time exactly, sorting what's the right structure, how do we align interests and the like. So that's the area where we think folks should keep a close eye on.
Yeah, that's a good point. I think we kind of see that in our daily lives as well, don't we? I've asked some of my family members and friends, what would you like for Christmas? And they're like, well, we don't want a thing. We want an experience. We want a trip. We want to go to a live game. And then you were just recently traveling around the world. You kind of saw that firsthand that there's a lot of travelers out there experiencing the world, right?
Now, listen, it was in Asia 2 weeks ago, down in Sydney, and the airports were full. The restaurants were full. UK this week, similar dynamic. So I think you're right, Michael. The reality is people have been, uh, you know, constrained from being out and about and enjoying things with people, and that we think is was why we're seeing what we're seeing, and we think that's going to continue for some time to come. You can also see it being expressed if you look at the inflation measures and how much of kind of the inflationary pressure that's in the system is being attributed right now to kind of the service oriented parts of the economy as opposed to the manufacturing and the goods parts of the economy.
Yeah. Well, one of the sayings you hear out there is for investment is buy low, sell high. There is Stu, right? And one of the things that real estate investors like to do, a lot of them, is look at the cycles and look at the opportunities to buy, right? And I think one of those sectors could be the office market. What do you guys see in 2023 and moving forward for the office sector?
Yeah. So certainly, it's going to be a continued story of have and have-nots in the office market, where the high-quality assets in major metropolitan areas throughout the United States and around the world that are particularly have a ESG orientation to them, LEED certified, et cetera. Those assets are going to continue to be of demand. We also think we'll see more of those market participants be creative around the types of their arrangements with their tenants. We think flexible workspace will will become increasingly of more importance, and so we think there will continue to be transaction activity in that portion of the market. For those assets that don't fit in there, the theme that we talk about. We've talked about it on your show, and we've talked about it in other forums. Is there is a lot of redevelopment and repurposing potential out there. The challenge is a lot of those situations are quite complex. So, in terms of the absolute scale that we'll see in there, I think it's a little bit hard to tell right now. But that's the part that we think needs to kind of go through some period of correction, and more effort needs to be put into kind of what's going to happen with that pool of assets over the long term.
Yeah, I think it'll be interesting to see on the cycle, if you will, for office properties. When does demand start to strengthen up and maybe supply dwindle from new supply, also to, as you mentioned, some of the properties being redeveloped for other uses. And then I think for some of the companies and employees to realize, looking back, maybe there were some benefits of having our folks together. But it'd be interesting to see, how long that takes to kind of turn around and increase demand.
And to be clear, though, we are seeing it happen. So, for example, I live in Washington, D.C., and in D.C., one of the largest office buildings in the market right now is being repurposed into a residential oriented themes. There's also certain parts of DC in and around the wharf areas down by the yards where there's a lot of redevelopment activity occurring. So we are seeing it already happen. I think the question is how much activity and does it ever get to something at scale, or is it more episodic? And that's the point. I think that we're still trying to see what happens.
So the overall theme then for 2023 on your outlook, what would you leave us with?
Resiliency, a focus on those sectors with strong secular tailwinds. The reality is more and more of the world is still moving online. So we're going to continue to see activity in and around logistics related assets. We still have a structural undersupply of housing in the United States and around the world, and solving housing affordability is an area of focus. So we think we'll continue to see activity in and around various elements of the residential related theme. And then this point that we've talked about and emphasizing again, as I mentioned, have a lot of more conviction around is things that are tied to people having an experience is where we think we're going to see the volume in 2023.
All right, well said, and we appreciate the experience of hearing about your outlook. Thanks for joining us today, Tim. We appreciate it.
Thanks for having us, Michael. Appreciate it.
All right, and thank you for joining us around the country. We'll have a link to their actual report at our website at creshow.com. We appreciate you listening and sharing and reaching out to us if we can help you in any way, if you have any questions or suggestions for us. So happy New Year to everyone. And until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. Appreciate the show? Consider referring business or doing business with our sponsors. Bull Realty is a commercial real estate sales, leasing, and advisory firm doing business throughout the Southeast, headquartered in Atlanta. Visit bullrealty.com for more information. Commercial Agent Success Strategies provides video training for commercial agents. This training gets 5-star reviews from even the most experienced brokers. Learn more at commercialagentsuccess.com. You're invited to connect with us on your favorite social media. You can find us on LinkedIn, Facebook, and Twitter. Don't miss a show of special interest to you. Be sure and subscribe to the show on YouTube and Apple Podcasts. And at the show website, creshow.com, you can subscribe for a weekly email announcing the show topic and guest. While you're there, you also found more videos and podcasts. Thank you for watching or listening to America's Commercial Real Estate Show.